Welcome back, everyone, to the BizBeat by SBA, the podcast that helps business owners stay informed and ahead of the curve when it comes to taxes, policy, and planning. I'm Lee Schwartz, Director of Business Development and Sales here at SBA Certified Public Accountants, joined as always by Eric Trost, our tax principal and firm president. Eric, how's this week going for you?
Excellent. Lee, I'm actually really proud of you.
Thank you. I can't tell you how much I've been waiting to hear you say that. But why?
Yeah, because it only took you 2 takes this time to get the intro right.
As opposed to my usual 15?
Right. I think you're getting it down.
Thank you. Well, maybe one of these times I'll get it on the first time. I wouldn't bet on it. All right. So before we jump in, just a reminder, if you've been following the latest developments on the One Big Beautiful Bill Act, make sure to visit sva.com/OBA. We've got resources, summaries, upcoming event information, all sorts of good stuff to help you stay up to speed and informed. So visit there. But Eric, let's jump in. Topic number one here today is something we really talk to clients about all the time, but we really haven't talked about on the podcast a whole lot. It's kind of a foundational topic that we discuss with our clients, and that is entity selection. Can you maybe give our listeners a little bit of an overview of what we mean by that, and then we can dive into some more specific examples of how that impacts business owners?
Yeah. So we'll start off with, now this is a big topic, and you could have a 4-hour seminar on it. So we're going to boil some things down here and try to get out some relevant, insightful information that can help people go forward and make a choice. But there's more to it than just what we're going to talk about. So I'm going to caveat our discussion with that. So we're talking about entity choice. This usually comes up when you have someone saying, hey, I'm going to start a business. Okay. So what should I be? And everyone's heard of corporations, and a lot of people have heard of LLCs. Maybe not so much S corporations. Maybe not so much, how the different kinds of partnerships you can be in Wisconsin or Colorado. So with all these types of things out there, how do you even make a choice? And, I think that you do it like a decision tree. You might look at it and say, is there a way that I can standardize a thought process around this? And this is what consultants tend to do, is standardize a thought process around it, where you start out with some default positions, and then you do a Q&A and say, well, based on this Q&A, you're going to go from a default position to something else. Now you might start with, okay, should I just be a sole proprietor and not form an entity? I don't have to form an entity to start a business. I can start a lawn care service. I can start my own dance instruction company. I don't have to have an entity to do a business in. I can just start doing it. What will happen is, though, I would say most attorneys would probably advise against that and say, well, you've got no legal protections when you run a business this way. So right now I'm playing lawyer. I'm not an actual lawyer. But what a lawyer might say is, hey, if you don't have an entity around your business and something goes wrong, you personally might be subject to any kind of claims of creditors that could come up. Okay. So those are all, again, legal words that I'm not allowed to say. So pretend that I was doing an acting bit there and just, playing an attorney.
We'll roll something across the bottom of the screen saying, not an actual attorney.
Right. Okay. Right. So you might say, okay, so what kind of entity should I form? And now when you look at forming an entity, generally what you do is these are formed with the state. So whatever state you're in, you go to the Department of Financial Institutions or what have you, it's called with the state to form an entity. So the states regulate the entity types. And so if you said, hey, I want to be a limited liability company or an LLC, that's a common entity choice that folks might say when they start a business. Very easy to form and move things in and out of an LLC. There's also corporations. You might say, okay, I want to be a corporation. What's known about corporations is there's certainly a long history there of legal protections that go with corporations. There's 100 years of laws regarding corporations and how they have legal protections, as opposed to LLCs, which are more recent, at least for us elder folks, more recent being within the last 35 years. So, so you've got LLCs, you've got corporations, and then you can make choices with those entity types to practice in front of or to do your taxes in front of the IRS. So if you choose to be an LLC, you can say, well, I can be an LLC. And if I've got other folks that are with me in the LLC, we can say we want to be treated as a partnership. So when you go and take your taxes in and you talk to your tax accountant and you say, we're an LLC, one of the things that the tax accountant might say is, okay, we have to file a partnership return. And you might say, no, 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 I said LLC. Well, in tax law, an LLC with multiple owners is initially treated as a partnership. So that's why sometimes you might hear your tax accountant use those interchangeably. An LLC is a legal entity. A partnership is a type of tax return that you file in front of the IRS, and there's all sorts of laws that go around how to do a partnership return. So you got to make that distinguishment there, but they're really talking about the same thing. One is legal entity, one is for filing taxes. Now, you could also say I'm going to be a partnership under state law. That's actually another legal entity. There's general partnerships, there's limited partnerships, different kinds there. Um, we don't see that as much anymore because the protections for an LLC, again, if you're talking to an attorney, are likely to be better than the protections for partnerships. So generally partnerships, you have to have a general partner and there might be issues with legal protections there. An LLC might more broadly cover those with legal protection. So an LLC has become that first choice of entity. So you come in as an LLC, you form that with the state that you're in, put a name on it, and now you can start operating your business under that LLC name. That LLC, again, will initially be said, okay, multiple people, you're going to tax it as a partnership. So all of a sudden now you've created this partnership tax return filing obligation. Or an LLC can have just one owner, and then it can be called what's the tax law refers to as a disregarded entity. So if you hear the term LLC and disregarded entity together, generally what that means is the LLC is disregarded just for tax purposes. So if I start a business and I form an LLC and I'm the only owner and it's a disregarded entity, then I don't have any separate tax return to do for that entity. The tax law looks right through it. That's only for tax purposes. That's not for legal purposes or any other purpose. It's just for income tax purposes. Generally that's an easy way to start. Form an LLC, and if it's just yourself, be a disregarded entity. Then the second step might be, well, I'm going to be making quite a bit of profit here, and perhaps I want to try to protect some of that profit from the system of taxation that happens with disregarded entities or sole proprietorships. So I'm going to be an S corporation, and it's fairly simple to tell the IRS, okay, how do I be an S corporation? You file a piece of paper. You tell the IRS, I'm an LLC taxed as an S corporation. Under state law, you're still an LLC. Your name has LLC in it. You haven't formed a corporation under state law. But again, this is for tax purposes. Now, for tax purposes, you've magically transformed yourself into a corporation that's taxed as an S corporation. The benefits of both of those, LLCs and S corporations, is that you get this flow through taxation, which means one level of tax. So even though you might have a separate tax return for your S corporation, all that income that comes into there goes onto your individual return as opposed to getting taxed at the entity level. So those are two entities that have those flow through taxations that could provide some benefits for them. S corporations being one that maybe saves you on self-employment tax by forming that LLC, electing to be treated as an S corporation, and then saying, okay, I'm going to pay myself some bit of wage out of here, take other money out as distributions, and garner some self-employment tax savings on it. So all of that for small businesses are things that you want to be talking to your advisor about, because as you head down that road, there are better ways, when you're forming those, sort of better or worse ways for tax purposes to form those entities.
So, Eric, is that really the main, I guess, benefit between being taxed as an LLC and an S corp, and that is the savings on the self-employment taxes?
Yeah, that's correct.
Okay.
That's the main benefit there. Now, the S corporation does carry with it a little more complexity because it has its own tax return. You have to do a payroll for yourself on it. And moving assets in and out of an S corporation could be more difficult than moving assets in and out of an LLC from a tax standpoint. From a logistical standpoint, you can retitle things in and out of your S corporation or in and out of your LLC. But from an income tax standpoint, taking assets out of an S corporation can cause a tax liability, even though there isn't really a gain recognized. So S corporations do have that downside. Now, the other entity to consider is a C corporation. And C corporations generally fell out of favor years ago. C corporations have a tax unto themselves. So the entity itself is responsible for tax. But then when you take the money out later from that C corporation after you've earned it, there's a second layer of tax, and that's called a dividend or a dividend tax or a capital gains tax that would occur when you do that. So C corporations fell out of favor years ago until the Tax Cuts and Jobs Act, when the C corporation tax rate was lowered from 35% to 21%. So when that happened, now you can start accumulating income in a C corporation, and that's a lower tax liability than if you're accumulating income as an individual. So the C corporation, while there's still that double level of tax, if you're not taking the money out, if it's an investment company that you're bringing in operational income and you're reinvesting that operational income into the company, a C corporation might be less tax, at least initially, until it comes time to sell it when the double taxation hits, unless you sell the C corporation stock and it's qualified small business stock. So that's another reason that people go to C corporations is, hey, now I can get into this. I can accumulate earnings along the way at a lower tax rate. And then when I sell it, if I sell the C corporation stock, I perhaps can exclude my gain using the rules of qualified small business stock. So those three entities are your basic choice. And you might say, if it's simple, I want to start with an LLC, knowing I can convert that to an S corporation very easy. Can also convert that to a C corporation very easy. And then over time, as your plans move and as you start getting operational income and you're looking for, okay, now I've got to look at more tax planning with respect to this, you might say, okay, now I should probably go and look at S corporation at least. And maybe down the road, if I'm long-term planning and I think I have an exit strategy that includes selling the stock, I might want to look at C corporation.
So,
So
Eric, great. We talked about sort of entity selection 101, but already I feel like it gets pretty complex pretty quick.
it
And there's a
does.
lot to think about here.
Yes. So I want to put these concepts out there just so that when you are talking to your advisor about it, just take this as a background. Okay, I know I've got these different types of entities. There's different tax effects of it. And I don't want to forget now the qualified small business stock option that there is with C corporation stock. So I can't rule that out right away, like maybe you would have years ago because of the double taxation. Maybe you don't rule it out now. So there's even more considerations on the table with the advent of OB3.
Right. So, and a great reminder, like just because you made an entity selection years ago doesn't mean it's the right selection for you right now.
That's
And
right.
so these are the types of things you need to constantly be revisiting to make sure you're planning for the future and in the right position for today.
Yeah, I mean these make big differences, especially on an exit, on your choice of entity right now. So it's a long term planning, but in when you enter into say a transaction or you're selling your business to the kids or whatnot, you'll be glad when that happens that you had these conversations back to set up your entity, or you'll be kicking yourself at some point in the future, going, "Oh, if I would have done this, I could have saved that on taxes," but you can't do it anymore. So these are the conversations you want to be having right now when your business is young and setting up your entity.
Yeah, absolutely. Thanks for that overview. I'm sure we'll be touching on topics as we go through the podcast, but a great sort of entity selection 101. Let's switch gears a little bit, Eric. Let's talk about the government shutdown. So I want to keep it vague on how long the government has been shut down because we don't want our listeners to know exactly when we recorded this, and also because I don't know exactly how long it's been shut down for. But it's been a little while. Can you talk a little bit about how, maybe already, but looking forward, if it continues to be shut down, how the shutdown might affect business owners, what they should be looking out for?
Yeah, well, it has been shut down for a couple weeks now. We'll just put it out there.
Yeah.
So I guess a couple things. One is, you may have noticed the sun still comes up in the morning, the moon still comes out at night. So the government doesn't run everything. There are things that do happen naturally over time that actually are uncontrolled by the government. However, the government does have a lot of effect in day-to-day society and in commercial, in commercial enterprises. One of the areas that is affected right now with the government shutdown is the Small Business Administration. That's the SBA. That's not us, SVA.
We get that confusion a lot, don't we?
Yeah.
SBA, SVA.
Right.
Yeah,
Sometimes when I'm on the phone and I call someone, yeah, I'm with SBA. They think I'm with SBA and they take me a lot more seriously. Oh, you're with the SBA.
yeah.
No, 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 SVA. And they're like, oh. So um, the Small Business Administration, they process loans. So they process small business loans. We talked about starting an entity, and you might be starting an entity to buy a business. And when you're doing that, you might get more favorable rates if you use what's called an SBA loan, which are loans that are in part guaranteed by the government. So you go and get an SBA loan. There's a process and an application that you go through that for that. And the SBA, which administers those small business administration loans, um, they are currently not processing those new applications. So they don't have staff to do that. So right now, if you're going to consider an SBA process, know that there's probably going to be a delay there before you can get your loan processed. It might put off plans that you otherwise would have had. So that's one area where businesses are being affected. And by the way, the SBA doesn't just do loans for startups and buying businesses. They have other places they do loans as well. The second area that I'm used to dealing more with is the IRS. The IRS has now furloughed about half of their workforce. So when I say furloughed, I mean basically they've laid them off. They're not working right now, and I'm not sure how they chose which half to lay off or not, and where that half exists. Are they all frontline processors that answer the phones and answer questions? Sometimes it feels like that, but it actually sometimes feels like that even prior to the furlough. Um, but as far as getting things through the IRS and getting answers from them right now, that's going to be delayed because of that cut in their employment workforce. And not only that, I think if you're going through audits right now and they've requested information and they're like, hey, we need this right away, you may call your auditor and they may be furloughed, because definitely some auditors were part of this furlough process. So what's happening, I think, is there's going to be a big slowdown in anything you're dealing with the IRS right now. If you're filing amended returns, if you're trying to do things that require humans on the other end of the line, like answer some questions or work through your account, just count on there's going to be some longer delays. And those that are left behind, they're probably working as hard as ever. And so this is the time that I know you might be frustrated in dealing with them, but this is a time that if you can show kindness to them and empathy with their situation, you might actually be rewarded with a better response, because they like dealing with you rather than someone that's screaming at them because they haven't been able to get through for a week and a half.
Right. And presumably, Eric, the longer the shutdown goes on, the more the backlog builds up and the longer it'll take to get through. And so this just plan on delays, whether it's the IRS or SBA loans.
That's right. That's right. And this is undoubtedly it's going to affect their audit processes and their ability, frankly, to even execute on audits.
Yeah. Okay. And we've been talking a lot about the IRS and maybe some slowdowns there anyway. So this is just sounds like it'll just compound things. Um, okay, great. Let's move on to the inbox. You can send your questions anytime to bizbeat@sva.com or drop them on the website at sva.com/bizbeat. So this week's question, Eric, another one we get a lot. Um, I'm looking to sell a rental property this year for the first time. How will this impact my taxes? So you want to cover that one for our listener?
Yeah. So I think what they're asking here, they've got a rental property, going to sell it. What kind of tax liability do they have to pay? I get it, especially those that are new in the business. And we do a lot of folks that have rental properties in our firm.
Yeah.
Especially folks new in the business, they often think that their gain on the rental property, so they sell it for X and they bought it for Y and the gain is X minus Y. That's not exactly how it works. And then some folks think that somehow, well, after everything's said and done and the loan's paid off, I'm going to net $50,000 and that's what I pay tax on. And that's not how it works either. You actually calculate your gain similar to what I said before, is you look at what you bought it for, but then you have to subtract depreciation that you've been taking over time. So that's one of those paper expenses that slowly moves the number down, that your cost basis down. So has the effect of increasing your gain at some future time. So you calculate your gain by taking the sales price minus expenses to sell it, and then minus what's called your adjusted basis, which is what you paid for it, minus all those depreciation deductions. And that's your gain. Notice what I didn't say in there is, and say anything about your debt. The tax law does not care about your debt when you're calculating your gain. They don't care if all that money had to go back and pay a debt. They don't care if none of that money had to go back and pay debt. Either way, your gain is the same. And what that also means then is your tax is the same. So when you're looking at calculating your tax liability, again, the debt is not part of the factors here. So calculating your tax liability, you take that gain and then you multiply it by what your appropriate tax rate is there. And most of the time, that's going to be capital gain, which is a 15% rate. Unless your income's under 50,000, it actually is a 0% rate. Or your income's over about 550,000, then it's a 20% rate. So there's different rates in there. And there's also a kicker rate based on depreciation that you've taken on your property. So there's a number of different rates in there. The highest basically being 25% for federal, which is that includes that kicker rate at upper levels. That only kicks in at those upper levels though. So you look at what your gain is, you multiply it by the appropriate tax rate, and that's what you want to talk to your advisor about, is where is your tax rate in there? And that's going to be your approximate federal income tax liability on that gain. Then don't forget about state taxes, because you might have a state gain as well, and then the state will want to take their share of that. And usually state rates are sitting around 5%. So does that Lee, do you think I've covered that with
I
how someone
do.
will calculate their gain?
I think the depreciation piece is probably a lesser known piece. I think the other thing that we hear a lot about, Eric, and you tell me if you think this is diving in too much or if I'm opening up Pandora's box, but like kind exchange, we talked about that a little bit in a previous podcast, but maybe talk about the role that a like kind exchange can play in this as well.
Yeah. So when you calculate that gain and calculate that tax, um, normally what you'd have to do is set that money aside, and then you'd be able to pay your tax bill, say in April when you did your tax return. You don't have to pay tax on that gain if you take the proceeds and roll it over into another rental property. So there's a way to take that gain and defer it, essentially not pay tax on it right now, by reinvesting those proceeds in another property. And there's a whole set of rules for that. You hear it called a 1031 exchange or a starker after an old court case where it was allowed. So there are ways to defer that gain for real estate that other investments don't have the benefit of getting, such as when you sell a stock for a gain. So there is that option out there to not pay tax by deferring the gain using something called 1031 or a starker exchange. That's probably a good topic for another podcast. We may have covered that at once, but I think it's good to cover that one again because it's
Yeah,
so
I
important.
agree. That comes up all the time. I think that's maybe not the 101 class, but maybe that's the 102.
Right.
That's next semester. Um, so, all right, Eric, that's great. I think we talk to business owners all the time, and even whether they're developers or just investors in real estate, or business owners who purchase a property for themselves. Like the rental property piece comes up all the time. So
Yeah.
that's something we talk about to our clients a lot about. So thanks for going over that. And I think that wraps up this week's episode of the BizBeat by SVA. Remember, visit sva.com/OBA for updates on everything OBA. If your group or organization wants a presentation on how the One Big Beautiful Bill Act might affect your membership, we'd be happy to schedule one. We've been doing a lot of those around. And make sure to subscribe on Apple Podcasts, Spotify, or on YouTube, and share the show with someone, hopefully a business owner that that would want to stay informed. As always, my standard caveat: these conversations, and maybe I need to reiterate this with all the conversations, all the legal conversations, but these are meant to be general and guidance only. For advice specific to your situation, get in touch with your business advisor and tax advisor. If your business and tax advisor is not here at SVA, reach out to me. Let's figure out how to fix that and get you a good advisor. Thanks for tuning in this week, and we will see you next week on the Biz Beat by SVA.
It's the Biz Beat by SVA, breaking down the news of the day, from tax tips to business trends, smart insights from trusted friends. The Biz Beat by SVA.